I'm going to show you exactly how I retired my wife using one simple option strategy. This is the same strategy that's making me $4,000 a month on average, and the same strategy that I taught over 10,000 traders who are now supplementing and some even fully replacing their 9 to 5 income. So in this video, I'm going to walk you through number one, the proof. So you can actually see broker returns that I'm making this, and it's not just some fluff thing, right? I'll show you the one simple strategy, which includes the back test, how we enter it, the entry rules, the exit rules, how we plug it into a broker so that you can walk away from this video actually being able to do it. I'll show you the risk management strategy so that even during a market crash, you can use this to make money. And we'll show you how to automate the entire thing so that it can be passive, so that you're no longer stuck to the screen. Because again, if you do this correctly, you might be stuck to the screen. So we want to automate that as well. So let's dive into the video. Number one, proof of broker returns. Let me make my face smaller so we have more room for action. Here we go. If I go to my broker, if I refresh the page here, give it a second to load, and then I go to the date filter and go year to date. So far this year, I've used this strategy to make $8,500. Now we're in the midst of a very big crash. I was closer to a $12,000 profit, which would put me around $4,000 a month. But again, we're about $3,500 a month right now, just based on how far it's been so far throughout the year, which is pretty good. And so again, I want to show you exactly what this strategy is, and it's a strangle strategy. I'll walk you through it very simply if you don't know what it is, but looking at the back test, you can see here that the performance is very consistent and very profitable over time. You can see here that we just have a really good win rate, about a 97% win rate, very consistent, very reliable, and something we can use day in and day out and make it a reliable source of income. And so for those who don't know what the strangle is, I just showed you the back test, but let's walk through the specifics, okay? Let's say you have a stock. Okay, this stock is just minding its own business and trending up, which stocks do most of the time. A strangle sells a put down here and sells a call up here. If you don't know what that means, it means that this level, I'm betting the stock stays above this level, which means as long as the stock stays above this level, I make money. So the stock goes up, I make money. The stock goes sideways, I make money. If the stock goes down, but still stays above my level, I make money. This is so much better than stocks, which only makes money if it goes up. So that's from the selling put, but I also sell a call, which means as long as the market stays below this level, I make money. And this means it can go down and I'll make money. It can go sideways and I'll make money. It can go up as long as it stays below my level and I'll make money. So when we combine these two things together, it's called a strangle. And I profit when the market stays between these two levels. And so that's what a strangle is. It can go sideways and I'll make money. It can go up but stay below my level and make money. It can go down but stay above my level and I'll make money. So in this way, I can make money in so many different ways compared to a normal stock trader. So this is what gives me the really high win rate. So that's what the strangle strategy is. I'm going to show you how to actually enter it in the rules, and then I'll show you it in the broker. So if we're diving in here, a strangle, the way that I do it is I like to, what's it called, skew my strangle, which means I like to change where my put and calls are. So you can see here, if the stock is trending up, which more times than not, stocks move higher. Stocks are in an uptrend, especially when you're trading and looking at the overall market, like the S&P 500, it tends to trend higher. And if that's the case, then we should leave more room to the upside and less room to the downside. So our call should be higher and our put should be a bit lower. Why? Because if it keeps going up, we don't want this call to level to get hit, because if it does, then we lose. So we want to push our call higher and have our put a bit lower so that we can use this to make money. So the way that I structure this trade is like this. I sell one call at the 5 delta level. This pushes it out very far, which I'll show you here in a second on the broker. And then I sell one put at the 10 delta. This one's a bit higher, a bit closer to the stock, so I can create more income, more premium, but also it's still on the safer side because markets tend to trend higher. So this is how you structure the trade. Again, 90 to 120 DTE is typically how far out you go for this trade. I'll show you what this looks like here in a broker so you can pick the right contracts here in a second, but I tend to lead more towards 120. So this is how the trade is structured. Next, how do we enter it? How do we know when to trade? The ideal market for a strangle is during a sideways market. So again, sideways meaning that we're stuck in between a high and a low, where they're bouncing up and down, but between two levels. This is the ideal market, but I'll do this in almost any market. Again, any bullish markets and sideways markets. Again, slower bullish ideally, but these are the markets that I traded in. And when I do, I enter on a weekly basis. So for instance, I'll do one trade a week. So for me, this looks like putting on a trade every single Wednesday. So that is how we do entries, ideally based on market, and then do it on a consistent frequency based on how much money that you have to use in your account. So that's structure, that's entry. Now for exits, what we do is we target, or at least what I target, is a 25% take profit. Now you might be wondering why so little. I do it a 25% take profit because then I can close the trade faster, which means I have less total trades open. So if we're putting on a trade once a week, and if we close it at 50% profit, that means I could have what, like 4 or 5 trades open at a time, which means I have 4 or 5 trades that could potentially bring me a lot of risk if the market turns around. But by taking profit faster, I'm able to actually close these trades faster and now only have 2 or 3 trades open at a time to reduce my risk. And it also gets me in and out of trades faster, so it's more capital efficient. Anyways, I also like to do a stop loss in case something goes wrong, a 300% stop loss on this trade. And this is what gets me around my 97% win rate. So this is how you structure the trade. This is how you enter, and this is how you exit. Now let me show you exactly what that looks like on the broker. My bad. If I go to the broker and I go to trade, again, you ideally want to do this on ES, or I should say futures options. The reason being is you'll get way greater leverage. If you don't have access to futures options, no worries. This works just as well on SPY, Apple, things like that. Ideally, you want to stick to ETFs though, because those are just more consistent and more stable, right? Because it's a strangle profits between 2 levels. So if you have a very volatile stock like Tesla that moves like crazy, it might not be the best. So stick to ETFs. They're more higher liquid anyways. So what I do is, again, this is the options chain. I look for the days that's closest to 120. So you can see here 122. So I'll click that. On the right side are my puts, and I typically start with the put. So again, looking at my delta, I'm looking for a 10 delta. So that is minus 0.10 is what a 10 delta is. 0.10, 10 delta. So right here, I'm going to sell this. I'm going to sell a put at the 10 delta level. Next, I'm going to go to the other side of the chart, which is the call side. I'm going to do a 5 delta. So you see here, delta 7, delta 5. I'm going to sell the 5 delta. Now, right now, this is going to bring in about a $54 credit, which translates into about a $2,738 return. You can see your max profit, about $2,732. Now, that is not the full profit, right? Because if I'm going to make that much, what I'm really doing is I'm having a 25% take profit. So I'm only going to make 25% of this amount, which gives me a return of about $700. But we don't really care how much money we're making. We care about being efficient with our money so that we can actually make a good return. And so from that, if we look at the buying power, it takes me, or I should say I have to put up $5,700 to enter this trade. So I'm going to divide my $700 profit by 5,700, and this gives me a 12% return on my money. This is great, right? I get to close a trade every 2 weeks, and in a matter of 2 weeks, I'm making a 12% return on my money. That's insane. That's insanely good, right? And again, this is 100 times better than bank interest, 100 times better than a bond or a loan or something like that. Obviously, there is more risk than other types of assets, but still, it gives me about a 77% win rate. And when I take profit at 25%, my win rate boosts up higher to 90, 95%. That is why the trade is so consistent, because we're closing early and we're going very far out wide, and it just results in a great return. So that is what it looks like, how we structure the trade, how we enter, how to place the trade on the broker. And so now we need to dive into the next part, which is how do we handle risk? Because yes, the upside is cool, but we always need to consider the downside, especially when it's an income stream and income flows that we want to rely on. And so if we're doing that from a risk management perspective, I actually just wrote a book about this called Never Worry About Volatility Again. It's on Amazon for $20, but because I love you guys on YouTube, I'm giving you a free instant download in the description down below. I don't know how long it will last, but I want to show you one of my favorite concepts from the book. Again, there's a lot of them. If you see here in this book, there's actually a checklist of everything you can do to massively reduce your risk. But my favorite one here is the Bollinger Band strategy. So if I come down here, strategy number 2 is the Bollinger Band approach. So again, it basically shows you that you can avoid entering new trades when the market is below or above the band This is used to identify overextended moves. This allows me to get out before the market crashes. Now, let me show you exactly what this means. Again, there's a video training on that inside the book with more detail, but here's how we do it. So if we're on a chart, again, whether it's TradingView or your broker, whatever, go to indicators, add the Bollinger Band like that. Now, this is what most people use it like, but what I want to encourage you is to go into the settings and change the length from 20 to 200. And just like that, it's going to show you a more accurate understanding of what's happening in the market. And what do I mean by that? The blue highlighted zone between the green and the red lines is going to show us where the market on average should be trading. What is healthy and normal for the market, aka a standard deviation approach to the market. Now, what we want to know is that when the market breaks out above these levels or gets close to the red line, that is a sign that the market is overextended and it's going to pull back. You can see here, it pulled back, it pulled back. We held around this red line for a while. We pulled back, right? This is a sign that we're actually going to pull back. And so what do we do in these red areas? If we're trading a strangle or really any option selling strategy and we get into these red zones, what we're going to do is we're going to slowly close out our positions so we can take risk off the table. What we can also do is we can purchase hedges. So we can do things like buying a put. Buying a put would make money as the market drops, which would help us profit from the downside too. So this is how we can avoid a lot of the risks with the strangle strategy, is just by understanding when is the market overextended and getting out before the market decides to pull back against us. Because when it pulls back, we'll see a lot of losses, VIX will spike. That's just a lot of issues we don't want to deal with. So if you want to learn more about the tactics that you can use to decrease your volatility risk, check out the free book down below. Includes a checklist and everything you need to know. Now, moving on to the next step here. We need to be able to automate this strategy so that we don't have to rely on it, right? Because if we're checking for risk management sections or entering of ourselves, emotions are going to get involved. We're going to mess up the trade, and we're not going to have the win rate and consistency that we're looking for. And so there are a lot of different softwares that you can use, but one of the best ones, and again, I'm biased because I made the platform, it's called the Options Auto Trader. And the reason why it's the best is it's the only platform that allows you to automate futures options trades. And so again, when you use that tool, you just plug in the exact rules that I gave you here. You say, hey, every single Wednesday, I want to sell a call at 5 delta. I want to sell a put at 10 delta. And then I want to do it at 120 DTE. I want to enter when this happens once a week. And I want to exit at a 25% take profit and a 300% stop loss. You do that, and now it fully automates your entire trading. And so that's the way to do it. Anyway, guys, that is how I basically was able to retire my wife from being a full-time public school teacher, and now how we're able to actually go travel. Her school year is ending in a few months, and we're going to go spend 2 months in California because that's where her family is, and it's going to be great. It's going to be awesome, and I'm glad that I'm able to give that to her. Anyway, guys, I hope you put this into action. I know it can probably do some great stuff for you. If you do, please put a comment down below. I'd love to hear from you. Anyways, hope to see you guys in the next video.